Good morning. This is Dylan Jovine with Behind the Markets. Happy Wednesday. Today is Wednesday, March 18th. What can an earthquake and fires that happened in 1906 teach us about the stock market today? I'm going to answer that question. In 1906, there was a San Francisco earthquake, which created a bunch of fires, basically destroyed San Francisco, leveled it. And I learned about this when I was probably 20, 22, 23 years old, young on Wall Street. And I was reading a book called Reminiscence of a Stock Operator. It's a book it's a classic, written in 1923, written by a man named Edwin Lefevre. And it's written about the life of a great stock speculator named Jesse Livermore. It's basically a biography, but written in first person on Jesse Livermore. And Jesse Livermore is telling the story to Edwin Lefevre, basically, that in 1906, that earthquake and fire, remember, back then, San Francisco had a lot of gold money, gold rush money, really big, prominent, and it was a big chunk of the entire U.S. economy. But also back then, news traveled really slow from the west to the east. In other words, Jesse Livermore, when he found out there was a big earthquake and fire in San Francisco, basically leveled the city, he went short the market. Because what he perceived early that few other people perceived was that, you know what, this is probably worse than people on the East Coast understand. And I better go short the market now. And of course, a year later, those are one of the key events that lead to the panic of 1907, where the market just broke out and just sold off. Now, what does that have to do with today? Right now, we are also in a situation where people might not be perceiving this very, very clearly yet. People have asked me, a lot of people ask me, are you short the market? Are you long the market? And I've said here for weeks since we started this that I'm in a risk-off kind of mood. Keep your sales in, keep really tight, sell your weaker positions. I talked about that last week. It's interesting. Right now, when you look at news that is more left-leaning, you get, oh, the world's coming to an end. The war is going terrible. The war is going this. It's, oh my God, it's terrible. Trump blundered his way into this. When you look at the news on the right, they say, oh my God, it's great. We've really got these guys where we want them. It's only 2 weeks into the operation, which is true. So it's very interesting. It's not like 1906 where news travels from the West Coast to the East Coast slowly, but there is a split screen of realities. And the split screen of realities really, it means that it takes a longer time for both sides to reach a consensus on which way it goes, on which way an issue goes. But I'll tell you something. So the market won't really start to collapse until both sides realize something's going on. But I will tell you this. JP Morgan was out with a note recently that said basically go long energy and short the market until the Strait of Hormuz reopens. And that's fairly reasonable advice. And again, it tracks with the advice that we've been giving. We haven't said go short the market. I don't really go short. I don't really trade that way. I don't like to trade. It doesn't match my emotional disposition as a human being. My emotional disposition is best matched just buying things and holding them. Buying things when nobody wants them, buying good companies and holding them till everybody wants them, and then selling them. That's how I'm wired. And you got to play the game the way you're wired, or you're just playing a game that goes against your nature. Anyway, so JP Morgan says go long energy, duh, of course, and we've been long energy. We've also been long defense as the world order really starts to shift a little bit. And JP Morgan recommends the United States Oil Fund, USO, and the First Trust National Gas ETF, FCG. And they say go short the market. Now, I don't say go short the market, but I say bring in your sales. Last week, I mentioned 4 steps that you should be taking right now. And step 1 was, of course, sell your weakest positions, your most speculative positions, things that you don't really want to hold for a very long time. They don't earn massive profits. They're inconsistently profitable, if that. And you just don't have that much faith in them. What am I doing with this thing anyway? Those types of positions. But when we look behind the scenes, we talked about the split screen, where people who get right-leaning news are perceiving this differently. People who get left-leaning news are perceiving this differently. And basically, the twain shall meet at some point. And when a majority of viewers view it one way, the market will either go way up or way down. The challenge is the most likely outcome is down because it's already fairly valued. And plus, the stock markets have 10 to 15% sell-offs every year anyway. So it seems like a great time to do that. When you look behind the scenes of all the blah, 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 behind the scenes, among professional investors, market liquidity is starting to collapse amid this. So liquidity in the S&P 500 futures is down to just $5.1 million. That is near the April 2025 Liberation Day lows. So basically, it's 61% below the historical average of 13 million. So levels below 7 million usually signal market stress, period. And to put this a little bit differently, let me put it two ways to you. It takes just a few $1,000,000 now in orders to move the S&P up or down a tick, but looked at it a little bit differently. Every time an institution tries to buy or sell in size, the impact on the market is now much larger than during normal market conditions. And so that means brace for more volatility. Brace for more volatility. So basically, everybody's frozen in place. And when we used to own a market-making firm, when I used to own a market-making firm, I started a firm called Liquidity Capital Partners. Whenever there were times like this going on, we would be bidding on stocks, let's say, because we made 100 markets, we'd be bidding on stocks, but we'd only be bidding like 1,000 shares. And the minute a big seller showed his hand to us and came and wanted to hit the bid and sell us a lot, we would run away. We would just buy 1,000 and go down. Whereas during a strong market, when somebody shows you a large amount of shares they want to sell, you're happy to buy more and just stick around and gobble it up when the market's going up. So right now we have a situation where people don't want to commit to down, they don't want to commit to up, but usually in situations like this, it's like where everybody becomes a deer. When they hear one snap of wood, a crack of wood in the woods, everybody runs. And that's the kind of market we're dealing with right now. So use this opportunity to lighten those positions of the most speculative stocks you have. And I'm not saying don't be in the market. You contrast that with NVIDIA's news that $1 trillion in chip revenue from then through 2027. And you still see the AI boom is really, it's accelerating, actually. So, you have this kind of split screen of the market too in fundamentals. That's why this market's not down 20% right now. Anyway, that's all I have for you today. Be careful out there. That's the headline. Have a wonderful day. I'll see you tomorrow.